This is Nightly Business Report with Tyler Matheson and Susie Garrett. Funded in part by
TheStreet.com and Action Alerts Plus, where Jim Cramer and fellow portfolio manager Stephanie Link share their investment strategies, stock picks, and market insights. You can learn more at TheStreet.com/NBR.
Good evening, everyone, and welcome to this special holiday edition of Nightly Business Report. I'm Tyler Matheson. Susie Garrett has the night off. Well, 2014 is almost in the books, and it's been filled with highs, many of them closing highs for the major indexes, and lows like plummeting crude oil prices. But that wasn't all that happened this year in the world of business. The economy and the job market hit a number of milestones as well. The healthcare sector dominated deal-making, recalls roiled the auto business, and a Chinese e-commerce company called Alibaba became the biggest IPO ever. Tonight, we look back on 2014, the year that was. With the Dow notching record highs more than 30 times and the S&P about 50, the bull market is now more than 5 years old. But 2013's perpetual push upward bumped into an old acquaintance late this year: volatility. From mid-September to mid-October, stocks dropped more than 7%. In November, stocks bounced back up to new highs. But in December, there was another slide. Stock prices wavered just as the Federal Reserve prepared to end its economic stimulus program. Talk of the taper hung over the markets like a cloud a year ago. Now, it's still about the Fed, but the question is when it will begin to push interest rates back up. Can the economy handle higher interest rates? Well, employment numbers are better, but real incomes really aren't, and inflation is still below the Fed's target level of 2%. One reason for that low inflation: an historic drop in the price of oil, down more than 45% from the year's high in June. Why? Well, it is as simple and complex as the law of supply and demand. Supply is up. The U.S. alone has increased production 65% in just 5 years. Demand, though, is decidedly down because the global economy is slowing. Here at home, the drop in oil pushed gas prices down by $1 a gallon and more in some places. Cheaper gas, of course, puts an estimated $100 billion back into the hands of U.S. consumers. That's about $60 a month for the typical household. But is that enough to get them spending again? Money's still tight for most of us. So where is the U.S. finding growth? Companies are still sitting on record piles of cash. Some of that money is staying overseas as the wait for U.S. corporate tax reform lingers on. But there's plenty of money to invest in the latest technologies, and corporate spending is helping to grow the economy. Tech is booming. Silicon Valley is a world leader. Apple's new iPhones are a huge hit. In Seattle, Boeing gets orders for more fuel-efficient jets from all around the globe, and Google expanded in New York City, which is suddenly flush with more than 4 million jobs, the most the Big Apple has ever had. Quite a year, and we'll start with Wall Street. The bull market, of course, proved it was alive and kicking. Major indexes closing at numerous records, almost too many to count, but it's hard to talk about the stock market without touching on what may be the biggest story of the year for investors: oil prices. So with us, Dom Chu, to focus on the stock market, Jackie DeAngelis on energy. Welcome to you both. Happy holidays.
Happy holidays.
Let me start with you, Dom, on the market. Sum it up in a few sentences for us.
If you talk about the market, you cannot forget that we've hit record highs upon record highs, like you said. So as we take a look at what's happened in 2014, this bull run is very much intact. But it was this time around, it wasn't so much a lot of the technology names that we talked about before. It was healthcare that was a real driver for the markets this time around. Those stocks, biotechnology, pharmaceuticals alike, lots of deal making, like you said, all of that drove that to be the best performing sector in the S&P 500. Of course, with those record highs, a lot of investors are calling into question whether or not they can sustain that going into 2015. Of course, the trend has been positive for a lot of them so far.
You know, and when you look at those sectors, almost all of them were higher, except the one that you follow most closely, which is energy. And were it not for the fall in oil prices, presumably energy would be higher.
It's been a huge drag, of course.
Huge drag. Lots of factors. We talked there in the piece about supply and demand. Is it really as simple as that?
It really is as simple as that. And actually, I don't think investors were expecting energy to be the story that it was in the back back half of the year. It certainly was no secret that supply was ramping the way analysts were expecting it to. As a matter of fact, this year we finally started producing over 9 million barrels a day. That is almost up to the point of what Saudi Arabia's output is right now. We never thought we'd be at that level. At the same time, the demand part of the equation is what took us off guard. When the demand started to fall off, that's when prices started to decline. And the question right now is, how do we curtail the supply to be able to meet the demand? Does the demand equation change in 2015 so that supply should stay stable right now? These are all the unknowns.
Well, let's talk a little bit about OPEC. Have they become irrelevant?
A lot of people were thinking that OPEC is becoming irrelevant, but I would say this last meeting in November really changed the game. When they did not change their stance in terms of production and the prices really tanked even further, OPEC was sort of showing some muscle and flexing it and saying, look, we're in this game.
So what's their end game here? Is what they really want to do to squeeze out the higher cost U.S. producers or squeeze them so they scream?
I think what they're worried about for themselves is losing share. So right now they're saying, we're going to eat the price decline, but we are going to hold on to market share. And if that squeezes shale, it squeezes shale. This is going to be a game of chicken, every man for itself, and it could get really ugly. Back
to stocks, falling oil prices generally thought to be a net positive for the economy, but in recent weeks, as oil has receded, collapsed in some people's view,
of course,
equities have hit a hard spot.
I mean, here the numbers are quite staggering because just this quarter alone, the last quarter, and we're only in the middle, we haven't even finished December at this point. By mid-December, just in the S&P 500 energy companies alone, that oil price decline led to declines in stocks of all varieties in the energy sector. So much so that just this quarter to date, we've lost about $265 billion, with a B, dollars worth of market value for these energy companies. So this slide in oil prices is huge, but it's also important to remember that the driver for the economy right now, oil is a big part of it, but it's a smaller part of the overall index than, say, technology and financial stocks. Those two sectors are the most heavily weighted in the index. You want to see some kind of leadership happen there. If oil prices can rebound, that's great as well.
So let's spin it ahead here. Why don't you go first, Jackie? What is the outlook for energy prices over the first 6 months or all of 2015?
Well, for the first 6 months, certainly analysts and traders alike are saying we could potentially go lower from here. Nobody really wants to call the bottom just yet until, again, they get a sense of really where this story is going, until some of the data shows us if the demand is going to come back on the table. Having said that, people have also said to me, once we do hit that bottom, maybe it's somewhere in the 40s, we will rebound quickly, back to the $60 or $70 range. So that probably could happen in the back half of the year.
And for you, Dom, we got last week some guidance from the Fed on interest rates.
We did.
What's the outlook for stock prices 2015?
Well, for 2015, what you're seeing a lot of experts say is that you're going to see the same level of valuation in the overall market, but it's going to match earnings growth. Earnings growth is not expected to be gangbusters, but it's still expected to grow. So a lot of experts are seeing, yes, gains in the stock market, but you're not talking about the 10, 15, 20% return varieties. You're talking about maybe that 5 to 6, 7%. Yeah.
Dom,
growth.
Jackie, thanks very much. Appreciate it. All righty, now to the economy, which is being helped by those low energy prices we just mentioned. But they didn't start out that way. If anything, the brutal winter slammed the brakes on much of the country's economic activity. But then the growth engines were turned on. Steve Leisman reports.
5 long years after the end of the recession, a period marked by sluggish growth and stubbornly high unemployment, the U.S. economy may have turned a corner in 2014. Beginning the year with a surprise decline in growth, attributed to weather but causing many to say, here we go again, the U.S. economy proceeded to rocket ahead, tallying its best 2 quarters of growth since 2003 and on track for its best year of job gain since 2000. Unlike previous post-crisis growth spurts, this time it didn't appear the gains would be given back.
It's pretty hard to find an economic measure where we're not significantly better off. I don't have to tell you about the stock market and where that's gone. Corporate profits, record highs, but also unemployment now lower than it was pre-Lehman. We've seen the housing market recover, although not as fast as we'd like. The auto industry recovering. We remain the most dynamic, innovative economy in the world.
Indeed, the U.S. looked like the shining city on the hill compared to other places around the world like Europe, which teetered on the verge of recession, and China, where the growth outlook was reduced. The differences were apparent in monetary policy. where the Federal Reserve took the momentous step this year of ending its open-ended quantitative easing or bond buying program launched in September 2012.
Looking at unfolding economic developments, and as the economy strengthens and we come closer to achieving our objectives, I think it's very likely that we will, progress on the path of normalizing policy.
At the same time, the European Central Bank looks set to take its first step into a U.S.-style QE program to kickstart its economy.
A QE program, which could include sovereign bonds, falls within our mandate, or better, is an eligible instrument that we could use in the pursuit of our mandate. Not to pursue our mandate would be illegal.
Next year looks to be one where the Fed takes another step towards normalcy, possibly raising interest rates for the first time in 8 years. But it's not without risk. If 2014 turns out to be another false start, the Fed could be moving too early. But if growth continues to be strong, the Fed could find itself behind the curve. For Nightly Business Report, I'm Steve Leisman in Washington.
One major component of the economy, the job market, and this year American businesses picked up their pace of hiring, turning 2014 into a solid year for job growth. A year ago, the national unemployment rate stood at 6.7%. Now it's down to 5.8%, the lowest it's been since July of 2008. In November alone, U.S. employers added more than 320,000 jobs, and 2014 is on track now to become the strongest hiring year since way back in 1999. The gains have come across all the major sectors, with professional services like accountants and engineers leading the way. Wages, though, have barely budged in 7 years, and though there have been signs of improvement recently, they are still barely keeping pace with inflation. Hampton Pearson's been covering the job market for us all year long, and he comes to us now from Washington, D.C. So, Hamp, we mentioned a couple of things that were strong points in job creation, but from where you sit, what drove job creation this past year?
Well, it was sort of a little engine that could syndrome, if you will. Looking at all those numbers, by the way, this time last year, the month of December produced only 84,000 jobs. And at the close of the Fed meeting this year, we had the Fed chairman trumpeting the fact that for the last 3 months of 2014, we've averaged 280,000. But to get to the core of your question, it started out with jobs essentially that did not pay all that well. It became widespread, and we're now at a point where, again, there's some competition for skilled labor and skilled jobs, and that's actually beginning to produce some wage growth along the way as well. And I think better jobs and better paying jobs will really have to be the job story of 2015.
You hinted at the answer to the next question, which is about the quality of the jobs created, and you seem to be suggesting that they keep getting better and better and better.
Yeah, we even in the November jobs report, we had a 0.4 increase in average hourly earnings. That doesn't sound like much, but it's one of the biggest monthly increases we've seen in quite a few years. However, year over year, we're only talking 2% wage growth. The Fed says it can actually live with 3% wage growth and still hit its 2% inflation target. So lots of room for, from the Fed standpoint for wages to grow. And really, I think you need that more spending power in the hands of consumers to keep the overall economy growing.
So what will it take to keep the job growth going, and what could potentially throw a wrench into it?
More of the same, especially that near-term hike we're all getting now from lower oil prices, putting more money in people's pockets. That, too, is going to boost those total demand figures in early January when we started to see what kind of holiday season we've had going forward. But the roadblocks along the way are still tight labor market in some respects. Is this growth for real? Can it be sustained? You know, have we really turned a big corner here?
All right, Hampton, thank you very much. Happy holidays. Hampton Pearson.
And the same to you.
You bet, in Washington for us. Still ahead, the auto industry was hit by major recalls this past year, but were buyers scared away from the brands that were hit hardest? The auto industry facing some of the biggest safety controversies in its history. It's been a big year and a big focus for investors, drivers, and regulators. Topping the list, recalls of two of the biggest, the Takata airbag recall and General Motors faulty ignition switches. Cars and trucks are selling. Almost 17 million sold this year. But recalls have automakers reeling. The year's biggest, about 18 million vehicles worldwide, has to do with dangerous airbags made by a Japanese company, Takata. At least 5 deaths are blamed on those defective airbags, and the recall list is still growing. Manufacturers, meantime, have refocused on safety. In the wake of GM's failure to deal with faulty ignition switches, blamed for some 40-plus deaths more than a decade ago. In its rearview mirror, GM can still see and feel the effects of a $35 million fine and a recall covering 15 million vehicles. Phil LeBeau has been tracking the recalls and their impact on the industry, and he comes to us from Chicago. Phil, welcome. It's been a record year for recalls, but how have those recalls affected the brands that have been hardest hit by them?
Well, it certainly has tarnished some of the brands. General Motors has taken a hit. Honda, because it's linked so closely with Takata, has taken a hit. But when you look at what's happened in terms of people coming into the showrooms, it hasn't slowed down sales at all. And that's primarily because these recalls, for the most part, have impacted older models. And when people go into a showroom, Tyler, they have short memories. If the model that's on the floor is not under recall, they tend to look at these recalls and say, well, that's somebody else's problem, or that's a 2008 model. I'm not looking at that. I'm looking at a 2015 model. Right. Some of the ignition switch recalls, particularly so on cars that in many cases aren't even made anymore. So with so many of these recalls, Phil, are the cars less reliable or more reliable? Actually, cars are more reliable now than they were 5-10 years ago. What's happened, Tyler, is that the globalization of the auto industry means that you have fewer suppliers, and so you have a commonality of parts, so that if you have one part that goes bad, and take a look at the Takata airbags as a good example, that one part goes bad, it affects millions of vehicles. And that's what we're seeing now. And likely we'll see this in the future, too, that when there are recalls announced, it will impact millions of vehicles. Let's talk a little bit about falling gasoline prices. I think it's in part responsible for the fact that we seem to be falling in love once again with SUVs. The Jeep Cherokee had a great year. So talk to me about that and what those gas prices may mean for the more fuel-efficient cars like the hybrids. Well, something like the Toyota Prius is a perfect example. We're going to see lower sales for the Prius and for other hybrids, and we're already seeing that this year. It's tougher to convince people that they should pay a slight premium to buy a more fuel-efficient gas-electric hybrid vehicle. It's simply tougher, Tyler, because people can sit there and say, well, why don't I just buy a compact car? I won't have to pay $3,000 more. However, we should point out that fuel efficiency is now part of what people look for when they're going into the showroom. So it's not as if people have forgotten about what happened 10 years ago when we fell in love with gas guzzlers. They're still thinking about that, but we are tending to go back towards the SUVs. Do we know anything yet about that aluminum-bodied F-150 truck and how it's doing, supposedly more fuel efficient? It is expected to be more fuel efficient. We won't know how the public reacts to that new truck until well into next year. We're just seeing them trickle into showrooms. The early reviews are very positive, but that's what it usually is with all new vehicles. Talk to me in the middle of next year, and then we'll see how the public embraces it. All right, we'll get back to you, Phil. Thanks very much. Phil LeBeau in Chicago. You bet. Now to the hottest industry for mergers and acquisitions this year, healthcare, a changing landscape and efforts to avoid U.S. corporate taxes through so-called inversion deals made for a very busy year for some of the biggest drug makers. Pfizer, Novartis, GlaxoSmithKline, Eli Lilly, the biggest names in big pharma, all the subjects of deal talk, big deals worth tens of billions of dollars this year. One reason, pressure on their product pipelines. It had some looking for growth outside their own companies. Another reason, taxes. Companies that could relocate to overseas addresses often get a tax break, though Washington did begin to clamp down on the so-called inversion craze with new rules in September. The biggest of the pharma deals, though, involved the Botox maker Allergan.
The hedge funder Bill Ackman engineered an offer worth more than $50 billion for the company, but Allergan steered away. And this fall, Allergan accepted an offer to join with Ireland's Actavis for $66 billion. And that wasn't all for Actavis, which already made a deal back in July to buy another American company, Forest Labs, for $28 billion. And coming up, the Chinese e-commerce company that made its way to the New York Stock Exchange and became the biggest initial public offering ever. Perhaps the biggest stock story of the year was Alibaba's initial public offering. Not only did it introduce investors to its CEO, Jack Ma, a colorful guy, but it also claimed the title biggest IPO ever. Kayla Tausche was at the New York Stock Exchange on the very day it started trading.
Alibaba is off and running. The Chinese e-commerce giant soaring above $90 in its debut after pricing at $68 a share. A company founded in the apartment of entrepreneur Jack Ma in 1999 with just a dozen partners, now responsible for 80% of China's e-commerce and valued today by the public market in the United States at $240 billion. Alibaba's business model is often described as a mashup between Amazon and eBay, but it's now a formidable challenge to tech companies here in the U.S. It's bigger than Disney, IBM, and JP Morgan Chase. But Ma said he draws inspiration from another U.S. corporation.
We hope in the next 15 years the world changed because of us. We want to be bigger than Walmart. We want to be bigger. It's not about the size. We want to learn from Walmart. They changed the business last century. They strengthened the B2C. And we hope 15 years later, they say, this is the company like Microsoft, like IBM, like Walmart. They shape the world.
Alibaba's platform sold $269 billion in goods last year, and its vendors were responsible for 60% of all packages shipped in China. Alibaba helps small businesses connect to new customers and in turn buttressing China's middle class. That's the main reason why investors have been clamoring for shares. They're willing to pay much more than the $68 IPO price set by the company, formally minting Hangzhou's Jack Ma as the richest man in mainland China. But his fight to grow Alibaba is still centered on the little guy, one he's often reminded of by a famous movie character.
The hero I had is Forrest Gump, and I watched movie before I came here. Again, for humility. Yeah, for coming to the New York, because I watched the movie again and telling me that no matter whatever changed, you are you, and I'm still the guy 15 years ago.
Alibaba, of course, is now far bigger.
And Kayla Tausche with us now for more on Alibaba and the other big tech stories of the year. You know, Alibaba, the IPO, biggest ever, came off seemingly without a hitch. How did it change the landscape and the willingness for people to back these big IPOs?
You know, people were a little bit hesitant to see a company that was technically based in the Cayman Islands with the bulk of its business in China, now trading here on U.S. soil. But investors really bought the story. They clamored to get the shares. And when I talked to bankers on the day of the IPO, they said there were twice as many orders for shares of Alibaba coming from U.S. retail investors than there were for shares of Facebook, Tyler. This has become a household name, and it's really broken down the borders of e-commerce. This company that really was an upstart came from nowhere and all of a sudden is bigger than...
Household name in China, but is it ever going to be a household name and a big player here in the U.S.? What do you think?
The expectation is that it will, and the demand from U.S. investors through their retail financial advisors trying to get these shares just shows you that it is starting to pick up a little bit. Now it's bigger than JP Morgan Chase. It's bigger than Facebook.
What?
When you think about that market cap, Jack Ma was just saying in that piece how he wants to be bigger than Walmart. Well, his stock already is.
All right, now explain to me the other one that may be on the radar screen for 2015, and that is Uber, the ride-sharing service. The valuations that are being tossed around for this company, if it does indeed go public this year, are astronomical for what I think is a taxi service. I don't get it.
Well, the key to something like Uber and the reason why now is the time that a company like Uber can grow so much is this little tool right here, the smartphone. This wouldn't have been the power behind a company like Uber were we talking about 5 years ago. But Uber now worth $40 billion. Just 6 months ago, it was worth $18 billion, which even then sounded like an astounding number. A year ago, it was worth $3.5 billion. But investors are saying that the earnings actually back that up, that Uber in a year's time could make $10 billion in bookings because people say, hey, I don't want to get stuck in traffic. I'd like to have someone drive me. And if the cost, I do, and if the cost is comparable to a taxi, why not?
All right, Kayla, thanks very much. Have a good new year. All right, thanks everybody for watching this special holiday edition of Nightly Business Report. I'm Tyler Mathisen. Have a great evening, everybody, and we'll hope to see you right back here tomorrow night.
Nightly Business Report has been funded in part by
TheStreet.com and Action Alerts Plus, where Jim Cramer and fellow portfolio manager Stephanie Link share their investment strategies, stock picks, and market insights. You can learn more at TheStreet.com/NBR.
I'm Susie Garrett with a Nightly Business Report news brief. The Federal Reserve dominates headlines these days, but what is it and how does it work? The central bank was created in 1913 in response to a series of financial panics. It was designed to provide the nation with a stable financial system. It does that by regulating banks and fulfilling two mandates, pursuing full employment and stable prices. One of the tools at its disposal, a key interest rate known as the federal funds rate. Today, that rate is near zero, an extraordinary step taken in response to the financial crisis to encourage spending by households and businesses. Investors are now focused on when that rate will start to rise and return to more normal levels. Most economists expect that to happen in mid-2015. Be sure to tune into Nightly Business Report right here on your public television station.